So now I want to talk about traditional or conventional commercial financing. And I just want to hit the difference between residential and commercial loans. And when I learned this concept, it really blew my mind. So I kind of hope you kind of had the same mind blown as well during this lecture. Okay, let's talk about residential versus commercial loans. So residential loans are for 1 to 4 units. They typically have lower interest rates. They're fixed for 30 years. You have 3.5 to 10% down, especially if it's a primary residence, and they're typically recourse. So if you file for bankruptcy, then the lender can go after you and your other personal assets. And residential loans are typically based on your DTI, or the debt to income ratio. So that they look at you first and then the property second. But once you start getting into the commercial loans, which are for 5 plus units, they have higher interest rates. They're fixed for 3 to 10 years, and then they're amortized over 25 to 30 years, and it requires a higher down payment. And 25 to 35% down is pretty standard. And they have non-recourse and recourse options. So what's nice about non-recourse is that if you filed for bankruptcy, they couldn't come after you personally. But to get the non-recourse option, usually the interest rate will be higher, and to mitigate that risk for them. And you can actually obtain commercial loans on 1 to 4 units, and the advantage is you can make them non-recourse. So overall, for commercial loans, they look at the property first and then you second. Residential loans, they look at you first and the property second. And what a lot of investors do is, after a while, you get kind of tapped out on your residential loans. So they'll actually put all the residential loans under a portfolio loan, which is a commercial loan. And at that point, you can do a large cash out refi and get it non-recourse, right? And it removes off your debt to income ratio. So everyone starts off in residential loans, and you naturally progress to commercial loans as you start to scale your portfolio. So for commercial financing, the lender looks at the property first, then the borrower second. So they're focused on the debt service coverage ratio, which is the net operating income divided by the annual debt service. And they just want to focus on the property's ability to produce income. And a rule of thumb is they want a DSCR greater than 1.25. Some lenders might want a 1.3. So the best way to figure out is just to ask the loan officer, and they'll give you that guidance there. And with residential financing, the lender looks at you first as the borrower, then the property second, right? So they're focused on the debt to income ratio, and it's really hard to qualify if you don't have a W-2 income. So that's where I started off with residential financing, with my single family homes. And I have a good W-2 income, but after buying 4 to 5 single family homes, my debt to income ratio really maximized. So I had no choice but to transition over to commercial financing, where they're focusing more on the property and the property's ability to generate income. So a lot of people start off with residential and they naturally progress to commercial financing. And this is probably where you're at, right? Right now, probably own a couple of single family homes, and looking to get more cash flow, and have the lender stop looking at you, right? So this is kind of where we all want to end up, and how we make that money to basically leave our W-2. So next, I want to talk about what commercial lenders look at in apartments. And remember, the lenders are providing the majority of the money on the property, so they'll do thorough inspections of the apartment complex, and they may ask for repairs prior to closing, like if the roof isn't good enough, they may either um, require the current owner to repair the roof, or at least give you a seller repair credit, and then the lender will hold that seller repair credit in their escrow account and will reimburse you after you have replaced the roof. So it really just depends on the lender. But they usually are focused on the big ticket items like the roof, the electrical panel, and any other kind of safety hazards that they find. And just remember, the inspector that the commercial lender uses is not as comprehensive as the inspector that you use during due diligence when inspecting all the units. And next, they want to make sure you have good occupancy history. Lenders will study the market history or occupancy and assume, your property occupancy is close to the market, right? So if the market occupancy is 85%, then they'll assume yours is at 85%. And, the higher the occupancy, that's better for the lender. And, the lender wants to see the T12 and see consistent income month to month, right? So that's their goal. And they want good financial history, ideally. They want to see a year to date and the prior 2 years of P&L, if available, just to see trends, right? Are the expenses going up? Is the income going down? Sometimes the owner may not have good financial documents, and the lender is happy enough with just a year to date. So overall, it just really depends on the lender, but just wanted to give a brief overview as to what they focus on. Now I want to talk about what commercial lenders look at as the borrower. And just like the residential lenders, commercial lenders will look at your personal debt to income ratio. They want to see a good credit score. They want to see how many liquid assets you have, and your overall net worth. So with commercial lenders, they look at the property first, then you second. But it always makes a strong case if you have a good low debt to income ratio, you have a strong credit score, and you have a good net worth, right? So net worth is kind of the key. And as a rule of thumb, if your loan is $5 million, then they want to make sure that you have a $5 million net worth. And that's why some investors need to partner, right? So they partner with someone called a sponsor, and that sponsor, they're literally doing nothing besides providing their net worth to basically secure the loan, and you have to give up some equity towards that sponsor. So that's kind of a workaround that you can do if you don't meet that net worth requirement. So that's kind of the nature of the beast. If you're lacking any of the categories above, you may need to partner, or you can do creative financing, right? So I have a whole module on creative financing and their benefits, where you don't get banks involved. And when you don't get banks involved, then it doesn't matter about you, right? And commercial lenders, they want you to have prior experience. But now you're stuck in the paradox that, well, how can I get experience if they're not willing to lend on me? And you can partner somebody, right? That's the easy solution. Or you can leverage your experienced property manager, which is what I did starting off. And lastly, a tip I mentioned earlier was, if you buy such a good property, it can override the fact that you're a beginner, right? So my first 26 unit, I bought it for $500,000, and it appraised at 750,000, and the debt service coverage ratio was like 1.4, starting off, and the property was so good, they never once kind of questioned about me, right? So there's always a way to bypass it. Just buy a deal so great that the lenders will overlook you, and in the direct mailing strategy that I will teach you, that's how you get those really good deals, right? Under market is buying it off market, and at that point, once you get your first deal, it gets easier. Um, Lenders will respect you more, investors will respect you more, and now you have a track record, right? So it just gets easier and easier over time, but just getting that first deal is hard, and the best way to get that first deal is to go off market. So now let's talk about ideal apartments for lenders, and they want good positive cash flow, right? That they want a DSCR greater than 1.25. They want you to purchase it under market value, and when it appraises over what you purchased for, it gives the lender security, right? Like, for me, I know prior experience. I'm working with a experienced property manager, but on my first 26 unit property appraised for $250,000 over purchase price. So between that 250K of equity day one, plus my 25% down payment, I mean, now lenders feel very comfortable, giving me this deal, despite my lack of experience there. So, like getting off market deals is key, and that's what I'm going to teach you in a later module. And, it takes a while, but once you get that first deal, it just gets easier and easier, right? And, the lenders want to see evidence of strong operations, right? So they want to see low vacancy on the rent roll, like ideally, above 90% occupancy. The P&L should be consistent month to month. The income, the expenses should be relatively consistent, and also, no deferred maintenance, right? Like the lenders don't want to work with somebody who's a slumlord. They're too cheap to fix anything. So, that's kind of the ideal, apartment for lenders. And when you start to scale, that's why you have agency debt, and you have non-recourse, right? Because they're just so confident in the asset, and it's backed by the government. So, that's when you start getting the better depth as you start to scale. So next, let's talk about what a bad apartment is for a lender. And, the first sign is no or poor financial records. And, this is very common with mom and pop operators. And, it doesn't mean it's a bad deal, but you just have to help them, create better financial records. Hopefully they were honest on their tax returns, and sometimes they aren't. But you can kind of pull the income and the expenses off the tax record, but it's a sensitive document, right, that to share. So a lot of operators or owners don't feel comfortable sharing the tax records. So you can just help guide them to just give you the numbers that they reported on the specific document, and help them create financial records using templates, right? So the lender, they have their templates for profit and loss statements and rent rolls, and you just get to ask your lender for that. And I also have some templates as well that I'll share with you. But this is an opportunity to help them and build trust, right? So that's how you gain the trust of these mom and pop operators, and show them that you want to help them, and um, and that's how you build the relationship. So the next type of property, it's poorly maintained, right? So I bought a 20 unit from a slumlord, and he didn't do any repairs. Like, he did the bare minimum. There was a burned down unit. He had poor insurance, so it didn't cover the cost to replace that, repair that burned down unit, and there's a lot of other things that were definitely deferred, right? And lenders don't like bad markets, right? So, what constitutes a bad market? It's a declining population. If there's no population, or it's going down, there's no demand for renters, right? It's losing jobs. A population follows jobs, and high crime, right? That's it's a lot of headache too, right? For you as the owner. So if the lender doesn't want a high crime area, why should you? Why would you deal with that headache? And next is high vacancy. So if the lender is avoiding these type of deals, especially in the bad markets, then you should too. I mean, if it's no or poor financial records or poorly maintained, but it's in a great market, with population and job growth and low crime, then at that point it's just a bad operator, right? And that can be mitigated, as long as you operate it as a business and not as a mom and pop. So yeah, hopefully this gives you a sense of what a bad apartment looks like for lenders. So what can you do about bad apartments, right? So if it's no or poor financial records, then you can do seller financing, seller carry first, where the seller becomes a bank, and it only works if it's owned free and clear, right? So if you seller finance, no banks are involved, and it'll help the owner save on capital gains tax. You can close a lot faster in 3 weeks. All you really need to do is a full property inspection, and if there's existing debt, then you can do subject to, right? So that's where they transfer the deed over from the owner to you, and then you take over the day-to-day operations, and you just pay the owner a agreed upon down payment, a agreed upon monthly payment, and then they will continue to pay their lender like usual. And I go into both these topics in a later topic, and creative finance could be a temporary solution, right? Like you can use that to then get good financial records and then get traditional financing later, right? So it just could be a 2 or 3 year thing, until you can document 2 years of good financial records, and then you can then pitch it to your loan officer and traditional lender and qualify, right? And the next type of bad apartment is poorly maintained, right? So when you do your full property inspection, you're going to inspect all the units. So if you have 50 units, you're going to inspect all 50, and it may take like a couple days and a lot of money to do this, right? But if you see a lot of issues with the property, then you can ask for seller repair credit. And what's nice about this is it helps lower your down payment, right? So if let's say you bought $1 million property and you need 25% down, so that's 250K down, and you get $100,000 of seller repair credit, then it reduces your down payment by 100,000. So you just come out of pocket 150,000, and it's nice, right? So, but you can save that $100,000 to do those repairs, and sometimes you don't immediately need to make repairs, right? So like I got $100,000 back in a seller repair credit, and they need a new roof, but it's not urgent. Like I don't need to fix the roof today, but maybe before the rainy season, I may need to start to fix that roof, right? So and if you do get the seller repair credit and the bank doesn't like it, then they might withhold some of that repair credit into an escrow account, and require you to immediately rectify those bigger issues the moment you take over, and they'll reimburse you back once you've proved that you've done it. And in bad markets, unfortunately, there's no solution. You can fix a bad property, you can fix bad financials, but you can't fix a bad market, right? So if it's in a high crime area, it's hard to fix that. If it's in a area with declining population job growth, there's going to be no renter demand. And if there's no renter demand, then it's going to increase your vacancy and decrease your rents, because there's not much competition, right? So, I just kind of want to emphasize on this slide that a lot of things have solutions. You just have to be creative. But if it's a bad market, there's nothing you can do about that. So, stay away from those type of deals. So let's go over the typical terms for a commercial loan. So, down payments, it's going to be higher, right? 25 to 35% down. In 2022 with the higher interest rates, you might have to down, 35% now just to give the bank a little extra security. And, the interest rates are, 6 to 7% right now in 2022. I was able to lock in around 4.3 in 2021. And for it's going to be fixed interest for at least 3 to 10 years. Typically if it's longer, it's fixed. You have a higher interest rate because there's more security, right? You're not at the mercy if the interest rates go up or go down in 10 years, right? But if it's shorter fixed, then it's a lower interest rate, but there's no security from a market shift, right? So, for me, I try to lean towards that 7 to 10 year fixed, whenever possible. Just to have that extra security, right? Even if you're going to do a cash out refinance, you don't know, things take longer in terms of renovation and stabilizing. And also, you just want an extra plan, right? Like what happens if interest rates continue to skyrocket and you don't want to lose your 4% or 4% interest rate there. Next, the amortization schedule, it's 25 to 30 years. If you use a national lender like Chase or Bank of the West, you can get 30 years. But if you use a local community bank, it's typically 25. It's harder for them to give you that 30-year AM. Um, but they're flexible on other terms, right? So it's kind of give and take there. And then you can get interest only for 1 to 3 years. So, there's no principal payments, so it helps increase your cash flow initially, and it gives you time to stabilize that apartment complex. So just wanted to give a brief overview about what the loan terms look like for commercial financing.